Took my first job after uni doing corporate finance at Ernst & Young. Wasn't for me. On day one, my line manager or mentor, what they call it, said, why are you here? I said, I want to qualify as an accountant and then go and start my own business. She was like, oh, no, you want to be here and get on partner track and work hard. And from that moment, I knew it was going to be very tough.
Today, I've got Jonny Plein here, founder of YASO.
People always say like VCs are sheeps and they go with trends. If you're not presenting an idea that they're really familiar with, it's more often than not you're going to get rejection. And fundraising for a business that's focused on China, using technologies that they won't understand in a market they don't know, meant we got a lot of rejections that from VCs that said, oh, great idea, it's not for us. If an investor's watching this is piqued by it, the fact that people are even scared of that is great for us. Less competition, less people willing to do it. In the time that the TikTok ban was talked about over Q4, our brands grew 300% quarter on quarter. And to me, when investors ask that, I get it, but it also shows that if we've got to Series A metrics, have we not disproved it in the last 3 years?
Welcome to FounderMetrics by Vested, the podcast that delves deep into the anatomy of business triumphs and the strategies behind the commercial success. I'm your host, Ifti Nasser, founder and CEO of Vested, and I'm so excited to take you on a journey into a world of inspiring founders. Good afternoon and welcome back to FounderMetrics. Today I've got Jonny Plein here, founder of YASO. Jonny, tell us a little bit about yourself and then we'll pick up on YASO and some of your other adventures a little later. But
fantastic. Ifti, thanks for having me. I'm a very proud, vested platform user. You've seen us kind of grow on the platform over the last few years. So thanks for having me on. So a bit about me. Born and raised in London. Went to university in Nottingham. Studied economics and Chinese. Lived out in China for a while, which is very relevant for what I'm now doing with YASO. And I don't know if it's conventional or unconventional, you'll tell me as a kind of entrepreneur's journey, but took my first job after uni doing corporate finance at Ernst & Young. Wasn't for me. On day one, my line manager or mentor, what they call it, said, why are you here? I said, I want to qualify as an accountant and then go and start my own business. She was like, oh, no, you want to be here and get on partner track and work hard. And from that moment, I knew it was going to be a very tough 3.5 years. So I quit as soon as I had qualified and I was allowed to go. And I started my first business, Pouch. I'm sure we'll get into what that did and what we did. Was fortunate enough to exit that business in early 2019. So the rare accolade of kind of exiting your first go at a startup, which I know is a very rare feat indeed. Worked at the Acquire for a while and then thought, I'm young-ish, got loads of energy, got loads of ideas. Let's put all this experience into another business and just go much, much bigger than what we did at Pouch. And that's what I'm doing now with YASO.
And that's brilliant. We will indeed cover both of them. But just going back to your time at Nottingham, my daughter was at Nottingham as well, and it was quite a noticeable observation how large the connection, and indeed you have Nottingham has a campus in China as well, so it's no surprise that your journey was going to lead you to where you are now.
Yeah, absolutely.
But tell us more about Pouch. I mean, it was an interesting one, Dragon's Den.
Yes.
You had a lot of interest. So tell us more about what Pouch was.
So Pouch as a product was a browser extension that automatically sourced the best available voucher code. So you may have heard of a browser extension called Honey that was acquired by PayPal. Fundamentally the same product, just in the UK, working on UK e-commerce websites, but with about 1,000th of the funding and maybe 5,000 less worth of an exit. They got sold to PayPal for like $4 billion or something.
Is that all?
Crazy. Yeah, it's insane. Still don't know why they paid so much for it. And you may have seen them kind of all over the YouTube sphere at the minute because someone took a takedown of them, which part is true, part is not. But Pouch was a browser extension. It was kind of a really quick journey. My friend Ben that you met at this conference we talked about, a friend from school, he worked in affiliate marketing, had this idea for effectively an on-site conversion tool that used a D2C model rather than selling the tech B2B, because he was a B2B software salesperson. And we thought, okay, we'll do this browser extension. And to be honest, I just wanted to do a cool startup because I was 24, thought I'd like meet some interesting people, learn a lot. And I thought, no way this will work. I had some savings from EY and I thought, okay, let's do the startup thing, learn a lot. It's going to fail. I'll go traveling, come back and get like a more interesting job. That's genuinely what I thought would happen. And I think that probably served me well because I was just there to learn and not thinking about the money too much or the stress. We got a lot of press around what we were doing because we were the first in the UK. Won some like accelerator awards in all the startup lists because we just had quite a cool product, and that led us going on Dragon's Den.
Dragon's Den, indeed.
And Dragon's Den was a great experience. We got offers from all 5 dragons, which I think at the time was like...
was a novelty.
Yeah, I think it was
the first.
I think it was the 3rd time in 15 years, which was just like insane.
Yeah.
And no one can take that credentialization away from you. Great for running PPC ads and Facebook ads against like 5 offers on Dragon's Den. And
certainly makes any subsequent journeys or founder journeys that you're going to have a lot easier with that sort of cred behind you.
I think so. And I mean, we kind of built the business on the back of 50 minutes of TV. We had raised in total like 300 grand, and we sold for like very, very, very low 7 figures. So sold for more than we raised, which is again now rare nowadays. And if we hadn't gone on the show and we hadn't got all the free press that came from it, we never would have got kind of lift off in terms of user growth and being able to test the product and be able to negotiate with retailers and all the rest. So it really did make our business.
So which of the founders did you actually go with?
So we went with Tuka, Tej and Jenny at the time, but actually the deal fell away like 2 months later because 90% of them do. It's really
but
just
why? For those people who are not familiar with how it actually works at Dragon's Den, it's been real insight.
Yeah, so effectively, like everyone knows the valuations are kind of nonsense. Like we're not going to go and value ourselves at 400 grand and give away 25% to someone. I think the deal we settled on was 75 grand, 25 from each dragon for like 18% of the business.
Yeah.
Like we had just weren't ever going to do that deal. So we said to them, look, we'll do this, but if you want this equity, you need to get us a number, or like introduce us to a number of leads each month, spend this many hours with us each month, or your equity is going to ratchet down. Because all you do is agree the price.
It sounds a bit arrogant. I mean,
from us.
You felt, felt like you were on the...
We didn't want to take the deal. We just wanted to get on TV. And they said in your terms that if you pull out of the deal for no commercial reason, they can go after you for their due diligence costs, which could be tens of thousands of pounds. Right. So you have to make the deal fall away. But also, if they're going to take like such a large chunk of the business for nothing, they've got to like be dragons and actually be involved.
Yeah.
And so the deal fell away, but we still got opening episode of the season, the big 15-minute slot. I think our clip on YouTube has got like 3 million views or something. Still probably drives downloads today. From that growth, we were able to carry on the business and eventually get an exit. So we were acquired by a company called Global Savings Group. In the transaction kind of announced, it happened throughout December 18, but announced, and the new role started in Jan 19. And can't speak highly enough of that business. They're amazing. I stayed there for 3 years, not because I had to, because I wanted to. We had an all-cash deal. I could have left 6 months later, but I just genuinely enjoyed growing the product. And I learned so much about how a kind of top startup is operated that it allowed me to kind of take those learnings into my new business.
Which is where you are now,
Exactly.
Which is brilliant. And if you were to think, you said it fell away very quickly, but was there any one of the dragons that you felt, actually, I could have worked for them?
You don't deal with them afterwards. You deal with their BD guy, who I still have a good relationship with, actually. He's gone on to do other stuff. But no, we met them in the room and that was it. And then you deal with their BD team. And I bumped into Tej. We were invited to speak at like an FT, Future of Retail conference. And he was there and we had a good catch up and chat. No hard feelings if I ever bump into them again.
Good. So tell us about where you are now. Obviously, we talked earlier about when you're a second time founder or once you've had an exit. It's quite a cachet, to say the least. So did you find it very, very different in terms of getting support for YASO? So,
yes. Short answer is yes. I think it's more a combination of experience, the fact I built a network through building Pouch. And when you can send someone a TechCrunch article, it does open doors. What I would say is it allowed me to get the first meeting much quicker than otherwise would have happened, but it didn't make the pitch any easier. So it opened more doors for sure. And it was quite nice to be able to go back to investors who I'd met for Pouch who said no, who I could say, well, you missed out on the last one. let's have a chat about this one. And a lot of them still said no for this one because it just wasn't what they were investing in. But I got the conversations, and it does, it takes a lot to sell a company, and it's not all like smoke and mirrors. There is some real substance to the skills that we'd all built, which made fundraising to a degree easier.
So tell us a little bit more about YASO first.
So YASO is an idea, I would say, for the three founders, myself, James and Adam. It's like 10 years of professional and personal experience coming together to build this business. So YASO is an e-commerce technology company, and we have built a solution for Western brands to sell their products directly to Chinese consumers. So we've built integrations with all the Chinese social commerce platforms, logistics, payments, data analytics platforms, everything a brand would need to sell directly into that market, which is a mammoth task. You're talking language barrier, cultural barrier, technology barrier, but we are unlocking the world's largest and fastest growing consumer market to brands that otherwise could not sell to them.
Yeah. Give me some examples of the ones that you're helping, if indeed you can, just so that people get a gauge. Because is it your Burberry's? Is it your the pouches?
One day, right now, because we needed to start with a vertical that we could grow and gain some traction in. It's all beauty and personal care products. So we've launched Cowshed, which is Soho House's skincare brand. If you've used that, probably if you've been to any of those, I'm
familiar with them. Yes,
yeah, certainly. You would have used them in the bathrooms of Soho House. Faith in Nature, which is a really popular clean beauty like shampoo and body care brand. Pixie Beauty, a New Zealand brand called Antipodes, and then another hair care business called Archive. So we've signed 6 contracts. The other one is under NDA right now, and we've launched all of those into the market, and they're all kind of making money in China as we speak.
Fantastic.
Yes, it is indeed.
Fantastic.
It is indeed.
So let's go to the fundraise.
Yeah.
For YASO.
Yeah.
How's that been? You said it was easier than when you were touting for Pouch. It's very different, but it's orders of magnitude difference in quantity as well. Pouch you mentioned was 75k.
Yeah.
From the Dragons.
Yeah. So we had some angel investment before that, but I think our first round for Pouch was £95,000 from angels. And our first round for YASO was 2 million from VCs.
So, as I say, an
completely
order of magnitude difference. The questions that you were asked by angels versus VCs, tell me about the difference.
So I would say the mindset of the fundraise was very different between Pouch and YASO. With Pouch, it was, I'm a young guy, very ambitious, I've got an idea. It was a bit cap in hand, like, are you willing to help? And I think our first angel ticket came from one guy, and he got like 20% of the business for 95 grand. Like, it was a great deal, and he made good money on that when we sold, because we didn't have any other choice. With YASO, it was, this idea is not one that's kind of thought of in the pub. Adam and James have worked in this China marketing and China e-commerce space for 10 years. We know exactly what we're doing, what we need to execute here. The market's absolutely massive. You should feel privileged to be getting on this rocket ship with us. So it was very much, if you want to invest, great. If you don't, I don't need you. And that kind of attitude seems to snowball.
Well, it comes across as well, and
it does.
It changes the dynamic in the room.
Yes. What I found, though, and maybe some of the other startups that use the platform know, anyone listening to this, is that people always say like VCs are sheeps and they go with trends. If you're not presenting an idea that they're really familiar with, it's more often than not you're going to get a rejection. And fundraising for a business that's focused on China, using technologies that they won't understand in a market they don't know, meant we got a lot of rejections that from VCs that said, oh, great idea, it's not for us. Really what that meant is, I don't understand it, therefore how can I, as a analyst or associate or even principal, take it to IC and actually convincingly sell this, because I don't know what it is, and there's so many other deals, I'm not going to spend time looking at this.
Yeah, exactly. It's
and I really understood. Yeah, for sure.
Them.
So to get over that, you've got to like build FOMO and build some credibility, and the fundraise took 7 months. Also, 2022, No, sorry, 2021.
I was going to say 2021 was good. Front end 22 was.
I'm getting confused over my timelines. We started raising 2022. I think the week after we announced the raise, Russia invaded Ukraine, and everything changed.
It did.
So I thought we'd walk 2 million. It would take us 3 months. It took us 7. At some points, we didn't think we would do it because we knew there was a level of capital we needed to build the infrastructure that allowed us to do 0 or 1. This is not a pure SaaS business. We have software elements to what we do, but it's not a build an MVP, get some users, initial traction. Either the full thing works or it doesn't. Mm-hmm. And we were stuck at 800 grand for a long time with people saying, if you've got a lead, I'll give you 200. If you've got a lead, I'll give you 250. So it was like, as soon as we have a lead that may write a 500 grand or 750 check, we'll get to 2 million. Finding that lead took a long time. Eventually, we were introduced to Playfair Capital, went through the process with them. Chris, their MD, who's now on our board, actually said no to us initially. And
on what grounds?
So
didn't understand?
No,
not for them.
No, Chris. Yeah, no, they're amazing. They really take a long time to get to understand the business. And he sent me a list of 10 or 15 questions, and I replied to them over email. And he basically said, "There's no red flags here, but actually, on the balance of risk, we're gonna pass. But let's have a catch up call to give feedback on why." He got on this call with myself and James, and I said, "Chris, this is not a feedback call. We're here. We've got half an hour. We're going to tell you why you're wrong." And we went through each of his objections and had data prepared.
You lost none of that boldness.
Yeah, just have to do it. After the fundraise, in fact, my now wife, she got me a mug that said, "You don't say no to Jonny Plein. Jonny Plein says no to you." And whenever I'm like pitching or selling, I have that mug because it's a good motivator.
Brilliant.
And we convinced Chris that he was wrong, and he changed his mind, and they led the round. And he said it's the first time in all the deals they've done, the hundreds of deals they've done, it's the only one that's ever been a no to a yes, which is a great feeling, kind of a testament to us as founders. And if you're willing to do that, you're probably willing to do what it takes to build the business.
Absolutely. You don't take no for an answer.
That's it. And they led the round, and suddenly, once you've got that lead, it's like the floodgates open. We couldn't, we were turning people's money away. I think we had 3 million in total offered to us. We took 2 with the thought that we only wanted 1.2 to 1.5. 2 is more than enough. Let's crack on, and we can raise later at a better valuation if we need to. So it was a much more dramatic fundraise than Pouch. It was a lot more difficult. Ultimately, we got to where we needed to be, but then the hard bit started, where you've actually got to turn that money into more money.
Vested is the leading ShareTech platform. What does that mean? It means we make funding rounds a dream, so you can raise with ease. Our platform helps founders secure investment, scale fast, and succeed, because companies that raise smart grow strong. So take the stress out of funding rounds and raise with confidence. For more info, search Vested. Without the second need.
So when they put the money in, generally there are a set of metrics that they're looking for. Mm-hmm. What were the key metrics they were looking for from you guys? Because, as you say, you were that early stage. You had product market fit, but
we didn't.
Just starting to.
We didn't have anything. Chris even said when we were negotiating, said, "Okay, you are 3 guys on a PowerPoint. Like, there is nothing here apart from your clear skill set, the experience you've had, the data you can bring from all of the projects Adam and James have done in the past." But it was a pure founder market fit reason for why they invested.
That's really interesting. Just tell us a little bit more about that founder market fit, where investment comes to us. Many folk will say, they've talked to people, everybody wants to see the traction, they want to see the product market fit, etc. Whereas you've got founder fit. Yeah.
So I think that when you're raising pre-seed, it's why you write to build this business. And there were obvious reasons why we couldn't have a product. Yeah. Adam and James had 10 years experience helping Western brands launch into China via an agency model. This is a platform model. So they had proof that they could do this already. We all speak Chinese. We've all lived out in China. I had my Pouch kind of operational experience. And it's a massive market opportunity, and a very few people have that skill set. So it was a case of showing to Playfair that here's all the work we've done to all investors. That means that this is why we think we can build this business. Yeah, this is why we think we're the right people to build this business. And here's why it's so hard for other people to do that. And that was the founder market fit that I mentioned. That, okay, well, there's like everyone can appreciate the Chinese e-commerce market is huge, but actually it takes quite a rare skill set to do what you're doing,
or even have a go at succeeding.
Exactly, and that's when how I define founder market fit. Now, we've done other things to kind of prove traction. We said we can't build the product yet, but this is what it's going to look like. This is how it's going to work. We had spoken to a lot of brands who we knew would be interested in YASO's solution, and effectively got them to say we will sign with them once it's built, which is a massive testament because it's a third party.
Yeah.
And the smartest thing we did is we got one of our investors who was generally doing due diligence, but I said, Mark, can you record the call? And when other people wanted like proof of DD or like customer fit, we would send them that link with both their permission and say, watch minutes 15 to 16:50. And that was basically the brand saying, this is why China is a real challenge for massive companies like us. This is why YASO's model is a great problem, like way to solve this problem. And this is why we're going to use them. So that was just like, okay, well, you haven't built the product, but you've done everything you can besides actually start building.
You know there's a real problem. You've got the skill set, so you've got the cred.
Yeah.
Excellent. So how big is the team now?
We are 16 people.
16 people?
Yeah.
Where's the split? Is
6 in the UK and then 8 in China with 2 remote devs somewhere in Eastern Europe.
Right.
James is responsible for that. Yeah.
So as you're building the team,
Yeah.
you're building out the product and capability, what is it that you're looking for to help you know that you're on track? As I said, there'll be some different metrics and their outcomes rather than either inputs or indeed leading edge stuff. But how do you get a feel for whether you are on track at the moment?
So I think with a lot of SaaS businesses, productivity tools, engagement improvement, there's a lot of kind of false metrics where say, oh, look, we've increased engagement by this much and this is why people love the product. We're not a nice to have, we are a need to have. If you want to make money in China, you need us. And our metrics are how much money are we making? That's it. Like, that's it. Are we making money for these brands or not? So actually, the things we're looking for are exactly the same things as our brands looking for, are exactly the same things as investors will be looking at.
So straight over turnover or?
So it's just, so we have a take rate of what we earn in China. So we don't buy stock, we're not a distributor. We provide the end-to-end solution for these brands to sell. So the brands give us the stock on consignment. They give us a marketing budget we spend to drive sales. And we do the rest. So we take 40% of anything that's sold in China as our take rate. And from that, there are other costs that are paid for, some of the logistics costs, like team costs, platform fees, things like that. We need to grow our take rate as much as possible. And if we're growing that take rate, well, then the brands are taking the other 60% to cover their marketing costs and their product costs.
Sounds like a big number, Jonny.
Yes. Well, no, not if you think about what we take away from the brands. They don't need to have any Chinese entities. They contract with our UK with our UK entity. They don't need any staff. They don't need any operational risk.
You're taking away a lot of hassle.
They get to launch and scale in China without having to add any FTEs. The marketing budget they'd have to be spending anyway if they were opening a new territory. The sticker we usually have are the goods on consignment, but we're not a distributor. We're not buying stock. We'll never buy stock. So we are a platform business.
Yeah, so it's pass-through of the products, and you make a cut on your success. Or on their success.
Exactly. So we win when they win. Yeah. There's no fees that we just tick along.
Your interests are aligned.
Absolutely. And the competitors in this model are local partners in China who charge the brands really high fixed fees each month. And if the brand succeeds, it's not really, like, it doesn't benefit them. Yeah. So when times are good, they're happy. But when times are bad, they're like, well, you're signed a 2-year contract. We'll sue you if you don't happen. We've seen examples of this from brands we've taken over. So on the surface, it sounds expensive, but it's also like a very low risk model to grow in a market that they want to grow in, that's attractive to grow in, that they're doing really well in. So I think we've commercially innovated in a way that makes sense for what we're doing.
And what about the geopolitics of it all? I mean, China is one of those places where presidents talk about it, big tech players talk about it from a positive and a negative perspective. Right now, it just, especially with the TikTok decision on, where do you feel you are in that mix? Do you feel threatened?
So the answer is, in no way do we feel threatened by what's going on. And this is not me trying to be brash. This is in evidence over the last 3 years. So every time we raise, what about the China risk? What about the China risk? Political risk. We work in a framework called cross-border e-commerce, where there's a specific tax rate on Western goods that go into China. The reason the Chinese government set this up, and by the way, you don't need to change your product formulations, you don't need to change your packaging. It's like the Chinese consumers have bought from your Western website, apart from
it's going to be delivered
its goods are held in market, you're selling through the Chinese platforms. It's a really smart way to encourage e-commerce. The Chinese government is investing in expanding the categories, the types of products, the types of ingredients. For example, like CBD is banned right now. That will change one day. And nothing since we started fundraising the business till today has impacted our ability to trade or do business. The biggest threat we had to our business was SVB collapsing with all our funds in it. Right. And the people kept asking, what about the China risk, the China risk? Maybe they were right, there was China risk, but not for us. For the American brands and the UK brands that are relying on TikTok as a growth channel. I would love to find one consumer VC that said to a growing consumer business, you're growing really well in America, TikTok's a great channel for you. Are you worried about it being shut down? That didn't ask it in the last 2 weeks, that asked this 2 years ago. Find me one, right? So maybe, there was an overall risk, but the direction has turned out to be completely wrong. So no, there is no risk. Look, people talk about invasions and all this other stuff. If that happens, there's a lot bigger problems. There's bigger problems.
Your e-commerce platform.
Exactly. And if an investor's watching this and is piqued by it, the fact that people are even scared of that is great for us. Less competition, less people willing to do it.
Well, I think
we're already operating. Like over in the time that the TikTok ban was talked about over Q4, our brands grew 300% quarter on quarter. There's no, we don't feel it in the day to day, and in fact, it's other people that are feeling it a lot more than us. And to me, when investors ask that, I get it, but it also shows that if we've got to Series A metrics, have we not disproved it in the last 3 years?
I think that's right, and I think it goes back to the point that you made earlier. There are few people who would be able to have the relevance and the experience that make you guys candidates to win in this game.
Yeah.
You've got yourself started, and that geopolitical or country risk for anybody else to overcome now is probably higher or harder than it was for you 2 years ago, because China was still in that safe space.
For sure. And I guess our position is that we are a UK company, and that we're the importer of from a technical perspective, we're the importer of record. So if there was some kind of trade restriction on American businesses in China, we're just another route, because we're a UK company. There's no restriction on the product type. It's just the companies that can do business. We're a UK business with our own Chinese entity that we own and manage. So we have set ourselves up for, no matter which way the wind blows, we can still continue to operate.
So what do you see now as the biggest challenges? And we'll come back to financing and growth, but within China, what are the biggest challenges?
Within China itself? It's a good question.
For you guys?
For us, I mean, nothing in particular. I guess there are some deflationary pressures that mean that we can't necessarily raise prices how we want to. But as I said, brands grew like 300% quarter on quarter.
So yes, volume is as important as
volumes exactly. And we look at the metrics of where our products are selling, and it's actually tier 2 and 3 cities. So in China, you've got a tier system. Shanghai, Beijing, Shenzhen are tier 1 cities. That's where you imagine a lot of the sales are. But actually, these social media apps, the Red Notes has been in the news recently, and your Douyins, which is TikTok, and Tmall, they are really popular in as much as in tier 1 cities and tier 2 and 3. So we're seeing a lot of growth happen there where people are still buying their first set of Western products, which is really exciting.
I mean, those tier 1 cities are mega cities.
Yeah.
So even your tier 2 and tier 3, just give folk an idea of what a tier 3 will be typically.
So a tier 3 city will still be 10 million plus people, right? That's still going to be bigger than any city in the UK. So you're saying, I get to sell to 20 cities all the size of London, all that have the same app system and the same logistics infrastructure that allows us to reach them, which is why when you kind of get it right, it really, really snowballs.
Yeah.
And that's what we're so excited for.
Amazing in terms of numbers and scale, as you say.
Yeah.
Never mind 20 of those, 6 of those is the UK.
Exactly. So and humans are bad at visualizing big numbers. Maybe I'll share a clip that you can cut into this podcast of just the number of people, even in these 30 cities. It is insane.
Yeah, no, that's fantastic. So, from a China perspective, you don't feel any risk. What about from a markets and a fundraising perspective at the moment? I guess you've gotten past that criticality hurdle, but what are you seeing about the challenges for your next round?
We're not at Series A numbers yet.
Yeah.
So 2022, we raised money. 2023, we built the system and tested it towards the end. Our first brand launch was only in April 24. So we only got like 9 months of numbers, and those have grown each month, which is great. But we need that 40% number to get to 70, 80 grand a month. That's what we need to do, and we're probably about 2/3 of the way there.
Vested is the best rated ShareTech platform. What does that mean? It means that we make share schemes a dream, and over 90% of our customers agree that their scheme has helped them to retain, recruit, and to lead and succeed. Because companies that share stakes share success. So get them invested by giving a slice of the pie. For more info, search Vested.
Without the second E.
And at what stage will you feel that at what stage do you feel you'll be ready to go to Series A?
So we're going this year, 100%. It will be it will likely be on the back of our June numbers, because from our pipeline, we're seeing, okay, we're going to have a great Q1. If we can smash that for Q2, it's 5 quarters of growth. And we know that in Q3 and Q4, because of Singles Day, it will continue. So it's a case of, okay, let's just keep going.
Singles Day.
Singles Day is like a Chinese Black Friday. It's the biggest shopping festival in the world. The numbers are just crazy. So we're definitely going to go this year. The challenge will be, we're not an AI company. So we use AI day to day in our tooling, but we're not an AI company. So we're not a hot trend. And also the business model is we're hard to put in a box. We're not an e-commerce brand.
Mm-hmm.
We're not a pure SaaS business. We're not an agency. I guess you would call us a revenue, a revenue-based SaaS product, because we onboard you.
Almost
the more you
trader,
use it. Sorry?
Sort of a trader.
Kind of, but we drive the sales, but it's not our stock, so we don't have the same risk profile of a trader. So it's kind of hard to put us in a box, and which can be great, but also when a VC is looking at 10 Series A deals, they're probably going to tend to something that they, again, like with our C, that they can understand. So we've got to make sure our numbers and our positioning is as clear as possible before we go out and raise.
So what do you think you're going to need to do on the numbers side? And what, as a consequence, do you need to do as a co-founder or as part of that leadership team now to get that to? Is it about the people? Is it about the
keep
product?
Doing more of what we're doing. And we've got the brands, and the numbers should take us to where we need to be. The way to guarantee safety, I would say, to get to that million of ARR, if you want, from our take rate, we need to add some more brands. but we've got a strong pipeline. So everything's within our grasp
So $1 million
to make it
ARR
happen.
by June.
By June, yeah.
And how far from that are you now?
Probably about 2/3.
2/3. Okay, so it's a reachable stretch.
Absolutely. So where we need to get to, like we've got everything in our hands, and the brands we're talking to, like there are some brands we're talking to that if we sign, we'll get there with just their signature in terms of monthly revenue. So there are opportunities that can take us well above that, and we've just got to keep growing the brands that we have and keep adding more. It's just purely down to the numbers, I think, is how we're going to be judged.
So assume success in June.
Yeah.
I guess it'll close a quarter or so later. But then what's the next big horizon?
So more categories. Right now we just do beauty.
Right now you're on beauty, yeah.
Just do beauty and personal care. We've had a load of fashion brands that have reached out to us that want to work with us, but we want to kind of make sure we're set up to do that. Food and beverage, there's loads of opportunity to sell kind of these snacks.
It's great to get
things.
one category, one sector.
We want to get one
sorted, demonstrated, and then you can branch out.
Then we can branch out. And there's a lot of tooling that we've built internally to help manage the China business that we know could be sold to other, so not even if they're our clients, but to other companies that actually may have a China team. We know they'll be struggling with this because we've struggled with it. We've built the tools to do it, to look at selling those. But just adding more brands, more categories. Like we're in such a tiny niche right now. The world is absolutely our oyster when it comes to growth.
A phenomenal opportunity set. And as you say, numbers in China are just difficult to comprehend, just the scale. It's fantastic. So when it comes to the team, obviously it's not going to expand in line with the sales, but do you see a much bigger team here in the UK?
No, we don't. I think in the UK, I think we probably need post-Series A. We don't. So everything we've done has been through organic. We've not got a full-time salesperson. We've got someone that does part account management, part sales. We don't spend anything on ads. It's all cold outreach and word of mouth.
Yeah.
And when we get to probably 10 brands, we'll need another full-time account manager. For the China team, I think, to be honest, we've probably hired a bit too much. There's spare capacity in the team, but come March, if plans go how there won't be any more. So it's our revenue scaled non-linearly and our cost scale linearly. So we've kind of said, right, we know we're going to have 4 or 5 more brands come on. We need to hire that one person. That person's in and onboarded, and the brands will come on in the next few months. So I would say we'll scale up. Cost linearly, revenues non-linearly, because that one additional FTE on 2 or 3 grand a month could be responsible for 30 to 40,000 a month of sales.
I mean, as you said, you're using the Vested platform, which is brilliant for your UK team. In terms of the team in China, how are you?
Unapproved options.
Unapproved options. So you're making sure that they feel vested in the business as well.
Yeah, absolutely. They. I think there's more of an appreciation from some of the senior team of how options work. From the junior team, we give it to them even if they don't ask, because if they ever have conversations, we want people to feel taken along on the journey. And just as founders, it's the right thing to do. These people are working hard for you, even if they don't understand what they're getting. You want to make sure that when we exit, they're taken care of.
I mean, often people don't, and it's a case of sharing what it is, because as you know, equity is that long wavelength reward rather than a instant cash benefit or bonus or crate of gifts at Christmas. It is for being on that journey with the team. And so for yourself, how are you seeing this? Is this just another step for Jonny, or because 1 startup, 2 startups, 3 startups more?
I mean, I'm 33. I've definitely got the energy for a few more in me. YASO is such a massive opportunity. We have to see it through. This can be a 100 million revenue business within the next 3 years. It's kind of the level we want it to get to, and I'm sure that the exit offers will come. I said on some other podcasts I've done this as, there's no nobility here. We're not trying to change the world. We have a commercial insight we're trying to execute on to make ourselves, our investors, our brands, our employees a lot of money. And I think that's fine to admit.
Absolutely.
And to build a business for that purpose is also quite good. I enjoy running the business. I get on so well with the team and my co-founders. I know early stage businesses die because they run out of cash or their co-founders fight. With Pouch, it almost happened for both. With this business, hopefully it won't happen for either. So yeah, just keep going and work towards that big exit outcome.
But I guess, just going back to you as a person, people have different niches or different parts of a company's life cycle that they feel more adept or appropriate for. Are you going to be as happy as you are ducking and diving, winning the game at this stage of the business? When it becomes that 100 million revenue business, is it going to become a bit staid, a bit too stable, solid, boring for Jonny?
I don't know. Let me get there first, and I'll answer you. I'm
right,
sure
so
not.
3 years from now, we'll
reconvene
come back together.
Yeah, and we'll see where we are. Either we'll be 100 million or we'll be dead. So it's going to be one or the other.
Well, I'm pretty confident that you're going to be right at the front end of that, and I think it's just brilliant. Thank you so much for
pleasure.
coming and sharing your journey and thoughts and ideas for our other founders. And
Perfect.
Good luck for the future.
Thanks very much. Cheers.
Cheers. Thank you for joining us on this episode of FounderMetrics. Remember, even the biggest of ambitions are completely doable when you know what to manage and track. If you enjoyed this episode, be sure to subscribe and you'll never miss another one. You can visit us on www.vested.com, where you'll find piles of additional resources, articles and exclusive content. You can also join our thriving community of entrepreneurs and founders by following us on the usual socials and YouTube. Until next time, stay inspired, stay driven and keep writing your own success story.